Welcome and thank you all for joining. My name is David Jorgenson. I'm the CEO of Equiteq. I'm very pleased to be joined today by business owners from across Europe and the US and a few farther afield from all sectors of the knowledge economy. I'm speaking to you from New York, and joining me from Equiteq's London office are Jerome Glynn-Smith, a managing director in our M&A practice, and Paul Dondos, who runs our origination and buy-side efforts globally. Please post your questions all the way through and we will answer at the end. Please use the Q&A feature inside of the webinar software. We will provide materials and a link to the recording to be sent afterwards. So we'll get started here on the first slide. Now, Equiteq's sole purpose is to deliver insight to owners of knowledge economy firms that helps them build and realize value in their firms through M&A. Clearly, the C-19 crisis has caused massive disruptions, but some strength has developed in the market, and in certain circumstances, the current market is favorable for sellers to achieve very attractive deals. We'll, of course, talk more about that in detail later. Our goal today is to give you some insight into why that is and help you make decisions about your firm and your personal journey as a business owner. Let's go to the next slide. I'll talk a little bit about Equiteq very briefly. Equiteq is the only truly global boutique active in the knowledge economy. Equiteq employees are on the ground in North America, Europe, and Asia, and we work very closely together every day. We have been studying and publishing on this market for 15 years, and that culture of research and data-driven insights gives us a very unique perspective. And while we are focused on M&A, we do it a little bit differently. Our own proprietary IP deals with the operational and strategic assessments of firms in the economy, in the knowledge economy, and that allows us to deliver value-enhancing advice and better outcomes for our clients. We're very happy to talk more about how we can help you later, and I'll remind you of that later in the webinar. So now I'll turn it over to Paul Dondos, who will walk us through the next few slides.
Thanks very much, David. So just to recap on the progress that was being made by a lot of firms in the years leading up to this year. Long bull market was increasing confidence in capital events. Firm owners were finding that multiple buyer groups were interested in acquiring or investing in their firms. And that's very significant. There were convergent plays of businesses that were coming in to acquire knowledge economy firms from totally different sides of the economy. Private equity was getting increasingly comfortable with knowledge economy firms that had previously been perceived as being risky for different reasons. And all of this presented owners of knowledge economy firms with what looked like an opportunity to plot their way towards some kind of liquidity event in, say, 2020 or 2021. And as they did that, we would work with those firms at Equiteq to help them to build out the kinds of buyer groups that they could be attractive to. We would help them to work on how transactable they were, how ready they would be for due diligence in a process they would go to, and how good the quality of their platform was towards some kind of an exit. So with or without us, firm owners were looking towards some kind of event in 2020, 2021. We can go to the next slide. So all that changed, as we all know, this year. And in terms of the capital available in the markets, we see now different scenarios. We're reduced to planning scenarios around what a recession could look like. Could it be a V-shaped recovery, U-shaped, L-shaped? Whichever one indications seem to be favoring at any point of time could affect the capital markets, could affect stock prices and indexes. But they weren't, these things aren't enough to actually move the M&A market, right? Deals can't be done when you don't have visibility of what financial performance projections are going to be in the near term, let alone further down the line. So we've seen the M&A market contracting severely during this period. It's very hard to start and finish a deal when you haven't met the person, of course. So all of this has had a severe effect on the way that owners look at their prospects for coming to market. When you add to that the commercial impact that the COVID disruption has had directly on different businesses, whether they are businesses that are in fact, and it's a minority, of course, but there are plenty of them that are flying in the face of COVID. They're doing very well if they happen to be in a space of employee engagement, workplace productivity that has to do with remote working and so on. There are many areas of the economy that are doing particularly well at the moment. Others that have been flat and the outlook is uncertain, others that are simply floundering. And that's just Q2. A lot of businesses coming to tell us about having had very successful Marches and being level in Q2, and Q3 and 4 are very much more uncertain. So that was the picture now going into this disruption. At this point, with no clear departure from that disruption, there comes to have an anticipation of a new normal. And as you can see from the illustration on the left, there is a kind of bell curve of exposure to COVID with those flyers and flounderers at different ends of that scale. And the market sees that, and the private market sees that in terms of identifying viable transactions. There are also considerable amounts of capital to be deployed, and with pressure to deploy them in the financial sponsors market, as much as in the strategic acquirer area of the buyer market. So this means that there is willingness to transact, there is urgency to transact. Increasingly, we hear about pipelines for M&A being light, and those acquirers are minded to find quality assets. And then there is this illustration of the COVID add back, which is something that has heritage in prior crises, but also something that is familiar within M&A processes, is depicting what is an underlying growth rate as prevailing over some temporary shock, as in the case of COVID, so that performance in the near term becomes explainable. And then at the bottom, you can see there that there is also the prospect of more risk to come for those that thought they could just carry on waiting or put things off for a year. There may be reasons not to do so.
Sure, thanks, Paul. I think I'll delve a little bit further into the details of why we're sort of cautiously optimistic for equity value realization in this upcoming period, and some of the points you highlight. So I think the view that we've formed, where there's short-term potential to realize value for business owners at this point, was initially driven by investor and acquirer side demand and the characteristics of it. I think that the first point is that the proportion of global liquidity allocated to investment in the private markets, what is sometimes simplified under the label of private equity, has never been higher than it is today, and it is destined to be deployed. That amount is estimated at $2.5 trillion at the end of last year. The second point is that for strategic acquirers to remain relevant to their customers, traditional lines between different segments in the market have blurred. The requirement for increased technology elements in the products and services that they deliver, or for them to build end-to-end capability across their service offering, has driven and will continue to drive M&A interest from trade acquirers. I think we've put together a few quotes here, but also if you look at our work at the moment, we've got close to 20 sell sides and fundraising projects at the moment within globally, with these dynamics from financial and strategic acquirers sort of driving those processes. We can move to the next slide. Okay, thanks. So we've seen in the market that there could be a premium that the current market conditions have created for businesses that have performed through the past few weeks, and that very importantly have been through the right preparation to engage with the investor and acquirer ecosystem. what the past couple of months have done is that they've provided a sort of stress test, which is significant, and where the businesses that have come out this side with further resilience or increased market share will be rewarded. You may want to look at the right side of this slide to benchmark where you would score your own business against these different points of performance. In general, across our client base, we see an average revenue reforecast for financial year 2020 of around 10% for project-heavy professional services businesses, and some businesses have performed better than that. In a similar way that when in March, market sentiment rapidly depressed, we believe that the increased visibility in the weeks to come on the economic impact of the pandemic will rapidly improve market sentiment, and that driven by further certainty and further definition of the risks that we are going through. What this will do is it will open a window where well-prepared and performing businesses will be ascribed a premium due to a combination of their strong performance through the COVID stress test, as well as scarcity of sellers at the moment in a market with improved investor and acquire sentiment. If we can move to the next slide. Right, so in this context where we see that there are drivers on both the buyer side as well as the seller side towards equity value realization, we're also seeing some changes in the way transactions are progressing towards closure, which we thought are worth mentioning. So we've selected 3 here, but we'll be happy to discuss if any further details separately from this webinar or in the Q&A session. So the first point lies within how this financial year 2020 is accounted for in earnout structures. Across our global work today, essentially we see a combination of 2 types of treatment for FY20. One where there is a specific earnout based on the performance, financial performance in FY20 that transfers some of that performance risk from this exceptional year to the seller. And there's another sort of treatment for 2020 where earnout structures are being pushed out by a year. What that means is that the earnouts are being pushed to 2022 payment based on performance in 2021. And what that does is this has been giving sellers more time to recover to normality and allow them to benefit from performance in 2021 without having their equity value depressed from exceptional performance in 2020. The second point that we wanted to bring out here is that acquirers and investors will accept COVID normalizations. The most frequent metrics that have been hit over the past couple of months are new client acquisition growth, what some people would call hunting, FY20 budgets that have been sort of reforecast. I mentioned some of that earlier. EBITDA profitability through the lesser flexibility of fixed costs in the overall cost base, as well as gross margin profitability. And for professional services, this growth margin adjustment is essentially through abnormally low utilization rates that have come in certain businesses and professional services through this, as well as cash management and working capital. And the adjustments for this this COVID exception are being accepted by the market. The third point we want to bring out is that creative deal making is increasingly normal to get deals done. So the exceptional environment in which we are involves technical transaction challenges such as normalizing abnormal working capital levels or allocation between the buyer and the seller of cash benefits from government COVID aid that need to be worked through, as well as practical challenges related to virtual management meetings, presentations, and building that necessary trust between the different parties that's essential to proceed to transaction closing. So on the more practical note of striking the right time for value realization, I think we should move to the next slide where Paul will take over from me.
Thanks, Jerome. So we've heard about how there are some buyers active in the market. We've heard about how there are ways of looking at financial performance that take account of the current environment, and that there are structures and ways of doing deals that can work in this environment. But aren't those going to be true in 12 months? Aren't those going to be truer? Couldn't you wait 2 years, see how things are next year, and then plan a process? Well, of course. And that may be the right approach for a lot of firms. However, there are things that you should bear in mind. Some of them have been all over the tabloids recently, and you can find also, universities and officials talking about these elements as well. So you've got to pay attention to them. The payments that have been made to support the economy, to support business owners, individuals during this time need to be paid for, and that's an obvious point. So how is that going to be done? Well, that could well be done by taxing individuals. That could well be something that causes a rise to wealth taxes, capital gains taxes, which obviously are going to reduce the benefits of going to market at a later period. There's also the uncertainty about whether things really will move on. And if there is optimism during a window which makes a transaction possible, if you're ready to go forward with a transaction when there is a window, that may be preferable to being exposed to what could be second spikes of disease, or the effects of fear in the market, a prolonged downturn, effects of unemployment, and so on. So that has a larger scale as well. As we've seen during this period, we have increased heated talk that's going on, certainly between America and China, to take the most obvious example. But the way that we redefine approaches to supply chains, the way that consumers behave, could have fundamental impacts on the way that on the business environment, and could change how attractive a business is for sale further down the line as well. So more time to get things in order is more time under uncertainty as well. And within the companies as well themselves, within the shareholder composition of companies, one of the hardest things that very often gets in the way of a successful transaction is having shareholders aligned. And we could find, I'm sure we will find in numerous cases, that the experience of this period will change the way that shareholders look at the future. And this could be a basis for misalignment among shareholders. So again, another thing that business owners will be exposed to by waiting. That doesn't mean it's urgent to ready the business for some kind of event, but it does speak to the merits of having a business in a position that you can hit the button if the right window opens, which may happen sooner rather than later.
Great. So as we look at what is our final slide of content here before we get to Q&A, a couple things to reflect on. The one thing, as this whole situation has become evident, one thing I've been surprised at is both how slow things seem to be moving in some respect, with things being locked down and a lot of uncertainty about when we'll return back to some sort of normal, contrasted with how fast the market is actually moving. And the speed of the market movement were certainly evident on the downside. When we were in late February and March, when it seemed like we were in a new reality almost every day for a few weeks there. But also as we return to identifying where the solidity is in the market, it's also moving very quickly. So I think what we want you to come away with from this session is really a sense that it might feel a bit contrarian at the moment, but there is a market there. The market is returning in certain areas very quickly and very aggressively. And we expect that to continue. Now, we don't know how fast a broad-based kind of tide rising type of market will return, and we're certainly not in that environment now, but there are very clear areas of strength. And so as we want you to think about, your particular situation, and are you ready, or is there a current and a near-term M&A opportunity available to you? We really think about it in four different questions. Are you a candidate for that COVID adjustment that we've been talking about? Was your historical performance, pre-crisis strong? And is there an articulatable and identifiable business model and path to recovery whenever the market, sort of drives that or allows it? Is there a premium asset story here, about your, about your business and ability to exit this, but also about your performance during this Q2 of uncertainty? Your readiness to execute, your ability to quickly, enter conversations with a party, and then also the forward risk. I mean, all four of these categories apply, both to your business and to the external market. And we think that there are category or very clear pockets of strength and solidity in the market. And so I think what we'll do now is we'll answer a few questions that have come in, and then we'll be finished in about 8 minutes at past. So I think what I'll do is I'll take a few questions that we've seen come in, and I'll hand first one to Jerome. Jerome, I'm wondering if you might speak to valuations and structures that we're seeing in our current deals. Is there anything that can be learned more broadly from what we're currently seeing in our activity, specifically around valuation, repricing, if any, and structures?
Sure. Thanks, David. And I think that's a key point, right? We've been talking a lot about there being appetite in the market, but then the question is sort of at what valuation, and that makes sense. I think what we're seeing across our deals is more creativity. I mentioned some of the points on the earnout for the performance of 2021. But we're not necessarily seeing a reduction in valuations. I think the general sort of thesis that value is very much connected to normalized and recurring growth and returns on capital employed means that this sort of exceptional activity isn't getting discounted by buyers, but it's getting kind of resolved through transaction mechanics as opposed to through price discounts.
Great. Paul, there was a question about who the most active buyers and investors are in this environment. Would you speak a little bit to that, and if there's any common sort of denominator across those firms that are actually being aggressive or maybe even more aggressive in this environment?
Yeah. So I think you can group the buyers in terms of their response and behavior. It's a number of buckets really that are becoming clear. There are buyers that are looking for distressed assets. Some of those with experience in doing this and capability for doing this. Others with others less so. There are buyers that are sitting on the sidelines, whether they say that they're still in the market for assets or not. Actually, they're probably not in a position to action much of that. And then there are buyers that really are more systematic. And even within those, again, there's a division between those that are systematic and have continued to be empowered to be systematic throughout this, and others that have been restrained. So into that final category, you have those, for example, financial sponsors that have been restrained in their activities by work that they had to do to resolve issues in their portfolios. But that was more of an immediate concern. And so we're starting to see those, independent of when we come out of this disruption, already coming back to the market to be able to progress conversations up to the point as far as they can during this period and get deals done. You also have the strategics that have been planning since prior to previous crises and seen how they came out more strongly, or could have come out more strongly, at those that are seeing this with a certain relish as an opportunity to create even more value, and if anything are dialing up their efforts to acquire, and not on that basis of looking for bargains so much as really looking for maximum value and looking at ways where they can gain market share disproportionately through this. And some of those we're interacting with on scanning through the market, again, not for the lowest common denominator assets at all, looking for where shareholders that were trained upon longer term growth plans can actually see the benefits of joining larger platforms or working with financial sponsors to be able to accelerate what were their aspirations already.
Great. There was one point to pick up on there. You mentioned distress, and Jerome, I wonder if you might speak to the topic. I've got some thoughts on it as well that I'll add. But are you seeing distress in the market? Are you seeing firms, really struggling yet, or already? And is distress kind of an identifiable aspect of this market right now?
Yeah, and I think that the key point there is the word "yet" that you mentioned, David, because I think there are sort of various steps before you get to distress and administration, and that kind of takes a toll on different stages and different stages of liquidity in the businesses. I think yes, there is an element of this market of businesses that I would qualify under liquidity crisis as opposed to under distress, and they are sort of providing opportunities to find further stability with investment from private equity and strategics, but we're not yet in a market of distress. I think it really depends on the rebound, and given the rebound that we're seeing, it may never be a market of distress, but just a market of some assets being in liquidity crisis. Right. Yeah, I agree. I think we're not broadly seeing a lot of distress at the moment. I think what we're seeing is challenging, but certainly challenging environments, particularly around liquidity. And I think distress is a question for down the road as it becomes more clear, what the recovery looks like. One additional question quickly for you, Paul. We're almost out of time, but there was a question about where from the more from the side and perspective of the seller, where are the real pockets of strength? What are the in demand sectors of the market and segments of the market, and what really drives that strong interest in a particular firm or sector right now? Where are you seeing the strongest demand?
So I think one way of looking at what's happening here that's been propagated, I think that's accurate, is that what we're seeing is a huge acceleration of processes of innovation, digitization, and optimization that were going on anyway. So the businesses, and they typically fall within the knowledge economy to a great extent across the knowledge economy, the businesses that deal with disruption, the businesses that deal with advancing processes into more efficient forms, digitizing them particularly, are the ones that are going to be in demand and are in demand at the moment. So that story around, for example, cloud migration, just to pick one, is one that has just grown all the stronger. Any businesses that were programming to take their processes online, put them in the cloud during the past few years, have now got to do that tomorrow, or yesterday, in fact, rather than putting that out any further. So suddenly there's a huge amount of work for those businesses. But any business essentially that works with advancing the economy through those streams of digitization, innovation, process optimization, automation is in great demand now.
Right, understood. Well, look, I think we're out of time. We're going to have to end the webinar now. Once again, thank you very much to everybody who's taken the time to join. We really appreciate the opportunity to deliver in real time some of the things we're learning from the market, and we are, of course, we always stand ready to speak to you more specifically about and confidentially about your particular situation. We will be providing follow-up recording of this event and also the materials, so you'll have all the information you need to get in touch with us if and when it's appropriate. And thank you again for attending, and have a good day.